Hi, everybody, and welcome along to the Mint monthly update for our single sector funds. It's myself, David Fyfe here, the portfolio manager, and I'll run you through what was the month of October and how the funds fared. Before I do that, I thought I'd touch on a topic that's getting a lot of airtime at the moment and probably has been for a few months now at least, and a bit longer in some areas, which is really on and on about the AI bubble. And I guess, while that's less applicable to the Australasian markets, certainly does have a ripple effect, and whether it's on tech multiples or other names, it certainly is interesting. Now, having seen a lot of research come over my desk and have had a good deep dive, there's certainly two schools of thought at the moment on it, and I thought I'd sort of touch a little bit on each side. But I mean, effectively, if you look at the chart on the left there, there's a lot of comparison to the 90s tech boom and tech bubbles in the early thousands as well. And some of the work people have done is looking comparing where we are now versus those times, and one of the big key points is the amount of spend that went on at the time within the dot-com bubble, and of course we're hearing a lot about data centers and AI right now. And as you can see, it's not really at a level that's it's crazy. It is a large portion and been a big supporter to US GDP, that's for sure. But in terms of absolute levels and relative to GDP, it's not at extremes yet, but it's something we keep an eye on. And again, there's a few arguments as well around the productivity levels we haven't seen come yet, but it might be a sort of longer dated background, but also a lot of the systemic risks and excesses that we look for are not there right now, which of course is around leverage, balance sheets we saw in the dot-com bubble, also around looking at credit spreads. We certainly haven't seen that widen out for the names, especially the Mag 7s yet in some areas, but also proper margin deterioration. We haven't yet seen that. So again, pretty strong balance sheets with a bit of cash. I guess on the flip side, in terms of the bubble, there's a lot of comments around that we have not seen that productivity kick yet that we were expecting. But also, looking at the charts on the right, we have seen capital expenditure, especially on data centers amongst the Mag 7s, tick up and continue to lift. And again, when you look at the chart in the bottom there, that's free cash flow generated from these companies. And we're actually seeing that starting to deteriorate. So I guess while they are generating free cash flow, we still have not seen that kick off in terms of upwards. It is starting to decline a little bit. So I guess there's an area we're keeping an eye on. And I guess, there's references to, I guess, the shale oil boom that we've seen in the past, which is a lot of capex up front. But once outputs are commoditized, is that a risk? So something we're keeping a close eye on. But in general, I think we know that there will be winners and losers. We don't think it will be widely systemic, but it will certainly impact the large US markets. But something we keep an eye on closer to home. And then, of course, going to the funds themselves, the New Zealand SRI fund had a solid month. The local market was up as well. There was again a bit of a month again for cyclicals, strong performances there. Defensive yields and growth names did okay, but not as well as some of the cyclical names. In terms of within the fund, we saw Somerset rebound after a weak prior month, as well as Napier Port and a few of the more sort of macro and housing related names. I guess over the month we did see the RBNZ cut another 50 bips, was certainly supportive of markets. But I guess one of the key features we did see over the month was a bit of a rebalancing within the gentailer sector. The nice colourful chart I put up there is really all about that squiggly black line going from towards the bottom there to the top, and that is really South Island hydro inflows. So it's a big change, and we always talk about the lakes getting dry, but as unsurprisingly winter shows, rain does arrive, and it can arrive very quickly. And in fact, overlaying this is the fact that snowmelt currently in the mountains is sitting at a pack higher than normal. So the lakes have been saved in a short time. And what does that really mean? It's actually been a beneficiary to the large South Island hydro generators, Contact and Meridian, and less so to Mercury. So as we saw, Mercury came back over the month because their North Island storage effectively is lowered in value. But in general, it's looking like a better year for the gentailers in terms of earnings, as we see the normalization of earnings alone and normalization of those hydro lakes. On top of that, we did see a strong month for Ryman, one that we've been underweight with a preference for Somerset, partly to do with its recent announcements around some increase in aged care payments supportive, but also actually the fact that they've got an ASX listing coming now as well. So certainly seeing some register move with some interest in Aussies have been buying up the stock as well. And the other interesting one we'll see shortly is around main freight with its result imminently due. And of course, that's a bit of nerves there around what freight and logistics is looking like, which ironically we've seen a reasonably solid update from Freightways, which is more domestic. The fair and main freight is more around some of its global and offshore. Another name in the fund that did well was ScalaUp. It provided an AGM update, trading well. In fact, it's guiding to pretty solid growth for the year. And in fact, for the first quarter, it was up almost 10% year on year. Now that's within an environment that tariffs have been impacting. It's both dairy and rubber industrial products. So it's another little local business that's doing particularly well. Now rolling over to the Trans-Tasman Fund, another solid month again for this fund. As you see in the top of the positives name there, it really came down to SRG, which is a diversified infrastructure services business in Australia, has done particularly well. And really what drove that over the month was a transaction they made for a business called TAMS. This business is really around marine infrastructure, as well as focusing on ports, as well as some defence resource and energy sectors. But really, this was a nice little purchase in terms of its recurring revenues. It's been strong. And so this is almost 30% accretive to the earnings of SRG. And so with strong recurring revenue, investors like that, as do we. And it was nice to see such a great transaction and saw the stock up almost 40%. So been a strong contributor to the fund. What didn't work in the month was a little bit of WiseTech, again, in the headlines for the wrong reasons, unfortunately, but more around an investigation by ASIC, the regulator in Aussie, just around some potential trading by individuals. So fundamentals of the business unchanged, but unfortunately, a bit of pain there for the share prices. Investors tend not to like these uncertain events. So one that we're keeping a close eye on, and certainly have been in touch with the board around what's happening there and what we can find out as it progresses. But again, nice recovery in Telix after a few tough months as well. So it's good to see some positive contributors in the main overweights within the portfolio. Again, REITs had a solid month, if not a little flat. The real key performers there was a mix. We sort of saw the start of some capital raises within the sector as companies have got closer to their book value. I guess the chart on the right there, if you look at that light blue line, shows where companies raised over the last decade. You can see there's a nice gap on the far right, and that shows that up until VHP's raise in 22, there'd been quite a gap, and that recently was solved with Precinct coming to market. Finally hit its book value, and what do you know, it came out with a capital raise. So as the companies have progressed, as rates have lowered, we've certainly seen that opportunity hit, and Precinct was the first cab off the rank, raising 300 million or so. That was well supported by the market. Again, in recent days, we've actually seen VHP do the same thing after raising capital to internalise their management contract from Northwest. Again, something that had been seen as a key piece of the business and helps align incentives for management and for shareholders and unit holders as we go forward, and is mildly accretive too over time as well. So yeah, property was reasonably solid. In Australia, it was actually some of the same outcomes, flat, but in fact, that was really down to a last week sell-off for the Australian market. And we did see there with Charter Hall being one of the overweights in the fund coming off. And that was really on the back of a surprise around CPI and really a focus on where rates are heading. The expectation in Australia is still to see more cuts, if not one or two, so not as many as we'd previously felt. On top of that, we are keeping an eye out for further cap raises. We think this will be a feature for the market, and something we're keeping an eye on. Certainly, there's a few balance sheets to tidy up, so one we're keeping a close eye. And we did participate in the Precinct and VHP raises, so it certainly kept us busy in the last while. And again, thank you everybody for your attention and being a part of the Mint Investment universe. And we thank you. And again, if you have any questions or queries, get in touch with us at info@mintasset.co.nz. Thanks for your time, and we'll talk next month.